Hey, good morning, everyone in business law. I'm going to put up a pretty quick um, summary review of the highlights or the important parts that I think are critical from Chapter 36, Types of Insurance. The chapter is very well written. I think it's pretty clear. Um, I don't know how significant it is for business law to talk about all of these different forms of insurance, but it's good to know the language because it's going to overlap with some of the types of policies of insurance you might want for loss on a building, or even if you're a renter, you can get business interruption insurance. So there's several different kinds of insurance you might want to worry about in terms of your calculus of whether or not you should purchase them, including automobile insurance. So I guess the chapter is pretty useful, but sometimes at first blush, I think, why is insurance covered in such a broad basis for business law? But I guess this is the place to have it. And it is important to know about insurance law, whether you're in business itself or just as an everyday citizen, because it is a very, very important tool to consider just in life itself. So it starts off with the different types of life insurance. Um, this is an area where there's some debate about which kind is best. I'm not going to get into that too much, I hope. The first one is term. You can literally buy a term of insurance. Say for the next 5 years, you pay a premium, and based upon your age and your health, the insurance company will make a calculation. And they'll say, okay, for X number of dollars, we'll give you a $200,000 policy on your life. Now, anyone can take a policy of insurance on their own life and they can name whomever they want as a beneficiary. However, somebody else can't take out a policy of insurance on my life unless they have a familiar interest, meaning they're my kid, my spouse, a loved one like that, or they have an economic interest in my life. They're a partner in a business and my death would cause them economic harm foreseeably. Now, it only matters at the time the policy is taken out. So, say I have a business partner in a law practice and I do one end of the practice, they do another end. And if he or I died, it would be economic free for all or injury to the other party. They can take out a policy of insurance without the other party's consent. Because they have an economic interest. There's no moral peril there. They're not going to incite a death in order to get a windfall. It's basically to help them seek to avoid loss of economic vitality. What's interesting about that is, so say me and my partner, they take out a life insurance policy on me, and we decide later on, hey, I'm just going to go purely academic now. I'm just going to teach at the Mount. I'm done with the law stuff. And my friend says, yeah, I want to do it. He's a part-time mechanic and he wants to do more mechanic work, and that's his passion. So he starts doing that. And now he keeps paying the premiums on his life insurance policy on me. I die. Can the insurance company object, saying, that person didn't have what we call an insurable interest, a stake in my economic life, nor a familiar one in me? The test is at the time of the inception of the policy. If at the time the policy was created, he had an economic interest in me, the policy of insurance is still valid, even though later, when the occurrence takes place, there's no seemingly economic stake or insurable interest in play, the policy is still valid. It's only at the time of inception we really look at it to examine it. So term, again, is a fixed rate. There's no benefit in it. Like I've had a term policy of insurance year to year. It's renewable on my life, and it has no value, even though I paid into it now. I bet you I've had it for almost over 20 years. I've had it, definitely. And it's just renewable each year. And I pay a lot of premiums on it. And so somebody might say, wow, that must have some value if you want to cash it out. It has absolutely zero value. That's what term insurance is. I'm basically covering myself in case I should die, so my kids have some coverage for economic needs, because I'm sort of the economic stability for them. And so if I die, there's some stability for them. But there's no economic growth in it. That's very different than whole life. I'm going to jump around a little bit because the book goes into the next one, which is a little bit rare. I might as well just go in order of the book. Next one's called endowment insurance. This is sort of an insurance plan coupled with a savings account. So say you get a $10,000 life insurance policy, that's an endowment plan. You'll pay premiums on that, and portions of that premium go to the coverage of your life. The other portion of the premium goes into a savings account that earns interest. It's almost an investment. Once the investment grows to $10,000, they pay either the insured, I took out the policy, or the named beneficiary, however I elected to do it, and the policy is ended. If I die before it reaches that $10,000, then they pay the policy to whoever I named as a beneficiary, or my estate, if I left it as my estate, which would be stupid. You always should name your beneficiary in the policy. But the next real big one's whole life. Whole life not only covers you for the amount of money. I've got a $100,000 whole life policy. I start paying premiums today. Over time, that will grow in value very slowly. It's not the greatest tool of investment, but it's a coupling of investment because it does grow and does come to value, and it covers your life while the policy's in existence if you should die. So my father, for example, he had a couple of small whole life policies, and maybe 4 or 5 years before he died, he wasn't feeling great. But he was retired. He didn't have a ton of money coming in. He retired without the biggest pension plans. So he decided to cash out some of his whole life policies. And so he had like $100,000 whole life policy, and I think he got like 40 grand out of it because he had invested many years onto that whole life policy, and he used it to fix up the home and basically live. And when he died, my mother was really upset because he said, "Geez, I thought your dad had 100." My father had several small insurance policies, and some of them he still had when he died, but that one he didn't. And my mother said, goes, "Oh, your father is so selfish." He goes, "Well, he got money out of it, and there was no real need to have a large life insurance policy that much later in his life. His house was paid for. He had a pension that was transferable, at least a portion of it, to my mom if she survived him. The need for life insurance isn't about, maybe it is for some people, I want to leave loved ones with this huge windfall. Usually it's about leaving loved ones in an economically more viable, or a business partner or business interest in a more viable economic situation, not suffer economic loss. My dad died. I was in my 40s. My sister and brother were in their 50s or 60s. My mother was in her 80s, and so was my dad. When he died, there was no real economic need other than, I hate to sound morbid, but we have a lot of what we call darker gallows humor in my family. Other than to get him into the ground and have a nice party afterwards, there wasn't really a lot of need for money. Upon his death, he was no longer, earning income in a traditional fashion. But that's a whole life policy. It has an investment quality to it. And if those of you, my favorite movie, I probably mentioned it a million times, It's a Wonderful Life. In the movie It's a Wonderful Life, George Bailey becomes very desperate to get some money, and he really has no assets to his name except a whole life insurance policy. And he goes and tries to sell it to this guy named Mr. Potter, the big banker in town. And I think it's a $8,000 policy, and I think he has $500 worth of equity in it. Most people don't develop too much equity in a whole life, but it's a nice tool later on if you find you don't really need the life insurance anymore. There's a little bit of a savings kitty there. Most people that deal with the insurance industry, if you're young and you're getting a life insurance policy, they urge you to get a term life insurance policy because it's much cheaper. There's not investment quality, and take the difference and invest it in something like a mutual fund, because the mutual fund will grow much faster than a whole life policy will in terms of its investment grade. Who cares, right? It's not really for this class. And then combinations. Insurance companies can craft all kinds of creative combinations between term, whole, endowment, and they can give all kinds of benefits. Matter of fact, my friend had one. His picture's behind me. He died, actually, we just celebrated, for lack of a better word, his 21 years of having since passed on May 1st. I'll give away the date. Didn't want to because I might reuse this video. But anyways, he had a type of whole life that allowed him to take out loans at very low interest against the policy's equity. And the policy stated he didn't cash it out. The policy remained. Usually when you cash out a policy, it's just dead and over with. But some policies allow you to take withdrawals from them. And he had one of that kind of combination. Insurance company, it's just like contract law. As long as it's not illegal against public policy, come up with all kinds of creative ways in which to cover people's lives. Are there some limitations on the life? Well, one is, in order to take out the policy on someone else's life, you have to have an insurable interest. So I can take out a policy, for example, on my mom. I probably could take one on my brother and sister. I think it's too remote to say I should be able to take one on my nieces, but I can take one on my spouse. I can take one on my kids. There has to be that familiar tie, so there wouldn't be motivation to have the death occur. I hate to sound morbid, but that's what they call a moral hazard. The other is I can take out a life insurance policy if I have a business interest with somebody else, and if their continued life is important to me economically, I have what's called an insurable interest. I can take a policy on insurance. Now, anybody else can take out a policy of insurance on their own life and name me beneficiary. I used to do this to tease my father. I worked for the state much longer before than when I joined the community college system. I had some crappy state job, seasonal one, and they used to make me have a life insurance policy, a $5,000 life insurance policy, pay very small premiums for it. And to tease my father, I used to name a certain politician here in Massachusetts that my father didn't really care for, just to irk him, and I named him my beneficiary in my insurance policy. I changed it later thinking, what if I did die? This politicians get $5,000 from me, and we're not from a very affluent family, so I really go to my brothers. This is back when I was younger, before I had kids and spouses and all that kind of stuff. But you can name anybody you want as a beneficiary. You can name a charitable society. You can put in your health insurance or life insurance that it goes to some animal rescue league or something like that if you want to. The other is suicide. So that's one limitation. You have to have an insurable interest. The other two the book mentions is that most policies of insurance won't cover you for suicide. That's usually within the first 2 years. And the thought behind that, they have all kinds of actuarial sciences in the insurance field, knowing what's likely to occur in terms of deaths, so they can pool the premiums to know their likely profit. As long as they have enough numbers in the pool, they can be very great predictors of what ultimately is going to happen. How many people that they have in policies are likely to die that year, how much they're going to have to pay out, how much profit they're going to make. But one of the things they usually exclude is suicide. They won't cover someone's, but it's usually only a 2-year window. And the thought behind that is, if someone's contemplating suicide today and they go take out a policy, they're not going to say, okay, once that policy goes beyond this non-contestability period, which is 2 years, then I'll commit suicide. Most people that can commit suicide aren't going to have that patience, if you will, to commit suicide. So after 2 years, take out a policy of insurance, 5 years later, the insured decides to take their own life. That policy will be valid, even though it was suicide, as long as you can determine that. That's one of the things you see in a lot of insurance policy contests is the insurance company will say this policy was taken out 4 months ago, and then the insured took their own life. And then the debate is, did they really take their own life, or was it an accidental death? Because sometimes the situation is a bit nebulous. There's not a suicide note, in the nature of how they died could have been accidental. And there's often trials over that very issue. Was it a suicidal death or was it an accidental death? And the other one is in activities of war. So you're a military personnel member and you're shipped off to Afghanistan, and say you got killed as a result of a forklift accident moving things over at the base. Would you be covered or not? That's a tough question, and I don't know all the law on that, but the book does a nice job discussing what does it mean about war activity. It says, if a member of the armed forces dies of a natural death, just has a heart attack, for example, the company must pay. In order to refuse payment, the insurance company has a burden of proving war activity. Well, I think if you're in the military and you're engaged in a war theater and you die in a car accident or vehicle accident, I think there's an argument that the insurance company said that was during basically engagement in war activities. But if you have a heart attack, cancer, things like that, and you pass away while in the military in a theater of war, the coverage would be allowed. Brain aneurysm, I don't know, I hate to be morbid, but the book does a nice job on it. Payment of premiums. Most people don't pay, like, here's 10 years of money for a 10-year policy. Usually what you do is you pay monthly or yearly on your premiums. If you fail to pay the premiums, the policy gets canceled. Almost every state in the union, I know Massachusetts has a certain too, there's a grace period. So I don't pay my monthly payment, this payment. Usually there's a 90-day grace period that I'm allowed to redeem the policy, basically make it whole again. And there is coverage during that grace period. Auto insurance is the same way. I never pay my auto insurance on time and I always get these notices of cancellation, but the notice of cancellation is at another 60 days and I always can basically cure the outstanding premium. That's called the grace period. And then again, the incontestability clause usually happens after 2 years. Depends on the policy. Change of beneficiary. You're always free to change a beneficiary. So I named a certain politician here in Massachusetts my beneficiary in that $5,000 policy I had. I later changed it and named my dad. This was many, many years ago. I didn't have kids or a wife or anything. And I named my dad the policy. So you can change beneficiaries almost, I don't want to say ad nauseum, but you really can. You can change them daily. And the same with a will, which we'll talk about in a later chapter. I think we touched on wills a little bit. You can always change your beneficiary. And sometimes the law will require to have a beneficiary. Sometimes you go through divorce. They might say, because of custodial situations, they'll say you're going to require to carry a period of life insurance for your former spouse. And they're going to require to keep one for you because if you die, the difficulty of raising kids during their minority will be pretty expensive. Assignment of the policy. This is very controversial. Basically, if I own a life insurance policy on myself, I can sell it to somebody else. I can sell the right for them to own the policy. They aren't the insured. I'm still the insured, but I'm selling basically the right for them to be the beneficiary. It was a powerful investment tool in the 1990s, early 1990s, when the AIDS crisis broke out. People with AIDS often couldn't get medical care they needed. It was very, very expensive, but they'd have these life insurance policies, and people would say, I'll tell you what, you got a $100,000 life insurance policy. I'll give you $20,000 to assign me the rights of your policy. And that's freely allowable. It's, I thought, very immoral. I knew someone who was involved in those kinds of things. But those kinds of investments are made. You can buy an assignment of the rights of an insurance policy. Um, the danger with that is well, what if they don't die in a reasonable period of time? You're going to lose your investment. And that's what actually happened with the change in the HIV community, was the treatment and the life expectancy has been expanded incredibly. So those investments are no longer valid. But you can do that if you can find someone who's desperate for money now and they're suffering from a terminal illness. You can buy their right to have the assignment of their policy. Annuity insurance, I don't want to get too much. Pays monthly income to the insured while alive. Buying annuity is usually not a great investment. But if you're a spendthrift, I'm a spendthrift, for example, meaning I'm just not really good at money. I blow it all the time. But wouldn't it be nice to know if I took this big lump of money and don't go crazy with, do something stupid, you buy an annuity and it pays you so much a month for the rest of your life. My fear is, I probably won't live that long, and then usually it dies with you. The annuity dies with you. You can't transfer it to somebody else, or if you can, it's only for a limited number of years. But it's not a great investment in most, if you talk to investors about the value of it, unless you're like me, a spendthrift. Joint survivor annuity, that's one that gives some extension that goes on to the second person dies. That might not be as bad. Now, property insurance, usually property insurance, you have to own the property, the thing, the real estate, the home, the boat, the truck, the car, the ATV. In order to get insurance on it, usually has to be yours. Or sometimes you can get insurance on somebody else's property if you have an economic interest in it. So if I'm in a building and I'm renting and I have a law office there, and I have, it's a very large law office, and I have several clients that meet with me and all kinds of computers. Obviously, I can insure the computers that I have in there, but I actually can insure the loss of occupancy in somebody else's building because I'll be economically harmed if they lost it. The book loves to talk, every book does, that talks about hostile fire versus friendly fire. So if you have a fire in your fireplace and it causes damage to your home, that's usually not covered because that's considered to be a friendly fire. It was intended to be there. Hostile fire is one where, you're cooking and you didn't expect it to get away from the fire, the stove where you're cooking on, and it caught some drapes and burned up. That's called a hostile fire. And all kinds of other insurance, business interruption insurance, which is great for business law. If you think for some reason, even COVID might have been something that might have been covered in many policies because your business was interrupted. And again, there's the leasehold insurance policy. It says, if one leases property for long term, a favorable lease, and the lease is canceled because of fire damage to the building, the tenant may have to pay a higher rent in new quarters. This increased rent loss can be covered by leasehold interest insurance because you do have an interest in the building continuing. The property insurance are a different kind. There's an open policy. You have to prove the loss there. Valued property, they already value the amount of money they're going to pay out if there's damage. Floating policy covers wherever your property moves to. Homeowners policy covers a lot of risks, not only to the home being dangerous, but also liability for negligence. If someone comes to my property, I have a defaulty step, I didn't go around fixing it, they trip and get injured on the step. My homeowners insurance usually covers that for liability for loss or damages. That's the loss damages of the property. All risk property, named peril, meaning they're going to literally list all the things they're going to cover. And sometimes a good insurance policy, if I was working for the insurance company as attorney, I write very clear language on what we don't cover because you just can't imagine. I see this commercial for Farmers Insurance where these oddball accidents happen and they have photographs or statutes of the occurrence of it saying, if it's happened, we've seen it or we've covered it. But think about it. The insurance company also wants to make money, and they don't want claims coming in that are bizarre or off the wall. So they often just want to say, "We'll cover you for this, this, and this, and this." But it's also not a bad idea to say we're not covering you for these other things. Description of property, coinsurance. This is almost like an algebraic formula. If you have 80% more coverage on the property, they'll cover partial damages for the full amount. So say I got a 90% policy and I suffered a $20,000 damage to my $500,000 home, they'll pay the full $20,000. But what if I have a $60,000 policy? Now it's called coinsurance. Now they'll pay, because I only have a 60% of the full value of the property, any partial loss, they'll pay the equitable portion based upon 60%. I don't know why it's so important, but every class I've ever taken always stresses this whole coinsurance philosophy. If they have a full policy of insurance to cover over 80% to cover fully partial losses. Otherwise, it's proportional to the amount under 80%. Repairs and replacement depends on the insurance company. It's usually at their option whether they're going to repair or replace. That's sometimes very controversial. Defenses and notice of lawsuit. Sometimes you're going to be sued for liability on your property. Usually the insurance company has the duty to defend, and that can be a lawsuit in itself. They can say, well, we don't have that coverage, so we don't have to defend. If it's debatable, they have the obligation to defend the lawsuit. Whether they have to pay any claim that's successful by a litigant is another question. But the duty to defend is considered somewhat of a separate analysis than whether or not there's actual coverage. Notice of lawsuits, that's the other big one. Say someone's going to sue me, what should I do right away? Contact my insurance company. A delay in notification is considered non-cooperation, and that's one of the things that could void their policy requirements. And that happens a lot in auto insurance. Somebody gets in a little bit of an accident. They say, I don't want to call my insurance company. I don't want to make good on it. And next thing you know, you're getting sued 8 months or 9 months later for personal injuries or property damage on the other person's vehicle. In your insurance company, you finally get around to notifying and they say, how come you didn't call us? Well, I didn't want to bother you. My premiums to go up. They say, well, we're not going to cover you for this. And the cost might be very expensive, and you might have to cover it as if you're the insured now, because the insurance company is going to walk away from the obligation because of failure to notify. Automobile insurance, the different kinds. Most people have fire and theft and comprehensive. You have to have comprehensive if you have a loan on it, because the bank or the lender, the mortgagee on the car, if you will, they're going to make sure that they're made whole. So they want comprehensive insurance, meaning if anything happens to the vehicle, there's coverage, and they are a co-insured. And that means that if you get money, like, I got $5,000 damage to your car, they're not going to give you the money. They give you in Toyota Motor Credit or you in Athol Savings Bank, whoever was the lender that allowed you to purchase that car. They put a lien on it, and they are going to be given the benefits with you because they want to ensure that the car gets repaired so it retains the value for their subrogation rights and the rights to basically foreclose on that vehicle or repossess. Collision, comprehensive, pretty straightforward. The one I do want to talk about is bodily injury insurance to others. Massachusetts, some states don't. I don't think New Hampshire requires insurance except after the first time out, and there's some weird rule there. But Mass requires insurance on an automobile, but we have a minimum mandatory policy. And sometimes, I think now it's $25.50. For a long time, it was $20.40. And what those two numbers meant was I'm liable, or I've got coverage for $20,000 of personal injury to any other person I might injure, pedestrian or other occupant of another car. The 40 is I have $40,000 for the aggregate of those people who are injured. So say there's 3 or 4 people in the car, there's $40,000 that's available to be distributed to them, provided they can prove that much in their losses. $20,000 per individual, $40,000 for the aggregate. This is, I think, a wise decision on your part if you decide to go, and they jump up. They have, I don't know, like 50, 100. I have 250, 500, because for the little bit more money in the premiums, I know if I injure somebody very severely, my insurance company is likely to be able to make them whole, and they won't go after me personally. And it makes me sleep at night a lot better. So that's the liability to others. And same with property damage. I think I have $1 million property damage. I don't know what I'm going to crash my car into to cause $1 million policy, but it doesn't cost that much more to have a lot of coverage when it comes to property damage to others. The other thing is called no-fault insurance, and we do have that in Massachusetts. Sometimes called PIP, Personal Injury Protection Benefits. I don't think it's in the book called PIP. But basically, your car insures anybody in it for up to $8,000 of medical bills. Regardless of fault. So even if I'm at fault and I do something stupid, I don't know, I'm texting and go off the road, I hit a tree and I'm injured, they'll cover me up to $8,000 of medical bills. However, my health insurance kicks in first, and then there's subrogation rights back and forth. It's a way. The reason why it's called no fault is it doesn't matter if it was my fault or someone else's fault. There's insurance covered for health to get medical care. We kind of want that as a public policy. That's why it's under the public policy provisions here in the book. I think it's called public policy. Public policy insurance, no fault. Doesn't matter whose fault it was, you get it. Now, some of the defenses to claims against you. One is the last clear chance. So say somebody's in a crosswalk. I'm clearly being negligent by looking down at my phone because a nice important text came in, and there's someone in the crosswalk, but they see me swerving over into their lane. They say, this guy's going to hit me, and they're standing there in the walkway. If they had the ability to simply take 2 steps to the left to avoid the accident, I could raise that as a defense that they had the last clear chance. It's kind of unpopular with jurors, but think about it. If you know there's negligence heading your way, do you have a reasonable obligation to mitigate the loss and try to avoid it? Of course you do. very difficult to prove if you're the one that's the idiot and the other person suddenly has an obligation to avoid your idiocracy. You can see the argument, how it often fails in front of a jury. The other is comparative negligence, which we do have in 48 of the 50 states. So say I'm negligent. I always think of the roundabout, those of you that are up at the mount and go to the mount. There's this roundabout rotary up by Haywood Hospital there, and there's I forgot what the restaurant used to be called, been closed for either. But the rotary's a little bit of there's like 4 or 5 different ways you get into the rotary. And let's assume I'm speeding, and I'm negligent because I'm speeding into that rotary. But the person coming in from the right doesn't really yield, so they're also negligent. We collide. Now the court will determine whether or not if I'm 50% or greater, I can't bring a claim against the other party because equity says I should be stopped from being able to sue because I'm at 50% or greater fault. But what if the other party is really 80% at fault and I'm 20% at fault? I can raise comparable defense not to win the case outright, but to have the amount of the judgment against me reduced by the proportional amount of their fault, provided it's no greater than 50%. If I can establish they're 50% or greater fault, they're entitled to nothing. In states that have what we call, I don't even know if it's in your book, and I hope it's not. Yeah, contributory negligence. It is in your book. It's mentioned. If we have contributory negligence, if the plaintiff is even 1% at fault, they can't recover because they contributed to the loss. That's a little bit unfair. Most states, again, 48 of them, including Massachusetts, comparative, that we reduce the amount of the judgment for the victim who's partially at fault, provided they're not 50% or greater. Once you get past that tipping point of 50%, they should not be able to pursue a claim, and that's comparative negligence. And again, we talked about no-fault insurance, last clear chance, required insurance. Sometimes you have to have insurance. Automobiles and MASH do. I think that's pretty good for a relatively, I kept it under 30 minutes. I still went on and on and on and on. And hopefully everyone's doing fairly well. We're getting close to the end of the semester with these materials. Next chapter I'm not too keen on, but we'll keep moving forward, folks.